had in the 1970s. In 1967, the stock market hit its high point at 1,000. 15 years later, the Dow Jones hit its low point at less than 800 in 1982. In the summer of 1982, the Dow hit its low point at 792. What that means is that over a 15-year period, asset values lost 20% of their value. But it was a lot worse than that. Why? What's going on in that whole period? Inflation, right? So when you inflation adjust those returns from 1967 to 1982, stocks lost 60% of their values. That was the worst period. That was the worst period since the Great Depression. And I would make the case. Then the question is that we talk about in the book. Why did that happen? Why did we see that dramatic decline in asset values? And what we talk about is this kind of period of what we call the three stooges of the American presidency. And that was basically Richard Nixon, Jerry Ford, and Jimmy Carter. And almost everything those presidents did on the economy was wrong. It started with Richard Nixon. You know, Nixon, people forget. How many of you remember in this room wage and price controls in the early 90s? Remember that? Which basically froze salaries. I mean, it was right out of an Ayn Rand novel. It was right out of Atlas Shrugged. We're just going to freeze. We're not going to let prices adjust. We're not going to let people get pay raises to try to stop inflation. Then people also forget Richard Nixon was the president who gave us, who took America off the gold standard in 1971. And what happened was we had a surge of inflation once we lost that anchor of a strong dollar policy with respect to gold. I always say that Nixon was impeached for all the wrong reasons. He should have been impeached for taking us off the gold standard. And then, you know, Ford gets in, and Ford was just sort of in and over his head, and then we elected the worst president of the last 50 years, in my opinion, in Jimmy Carter. Carter, you know, did all of the, you know, by the way, the thing about Jimmy Carter that amazes me is as horrible a president as Jimmy Carter was, isn't it amazing he's proven himself to be an even worse ex-president than he was president? I don't know how he accomplished that, but every time he opens his mouth, he says something stupid. In any case, you can see here that the policies get worse and worse. You know, we had the wage and price controls, and there were windfall profits taxes, and the melee speeches, and all of this stuff, and the economy just hits bottom in 1981. And then what happens is that God smiles on America, and he gives us Ronald Reagan. And the sun comes out, the clouds disperse, and we have a radical shift in policy that takes place with the policies of Reagan that were based on the principles of sound economics, lower taxes, lower inflation, and so on. In fact, we have a wonderful story in the book. I do love Reagan, and Reagan, there's so many great stories about Ronald Reagan, but one of the best that Arthur Laffer tells in the book is Laffer was Ronald Reagan's chief economist. So he was there at the very beginning in all of these meetings, and he has this wonderful story about Reagan that you guys, I think, will really love. I think you'll love this one. But Reagan, when he had his first cabinet agency meeting, when he first enters the White House in January of 1981, and there seated at this table are, you know, Ed Meese and Gene Kirkpatrick and, you know, all of these really, you know, brilliant people, and they're all waiting for the marching orders from this new president. You know, and this is a time of unbelievable economic turmoil. We're deindustrializing. You know, it looks like capitalism is in retreat, communism is rising. You know, we've got Soviet troops in Afghanistan and Soviet tanks in Nicaragua and so on. And so you know, not just an economic turmoil, but also foreign policy turmoil. So everybody wants to know what this new president's going to do, what he wants them, what are the marching orders. So Reagan sits there for a while, and as Arthur Laffer tells the story, you can hear a pin drop in that room as everybody's waiting to hear what he's going to say. And finally he stands up and he says to them, "Gentlemen and ladies," he says, "I hate taxes, and I hate inflation, and I hate the Soviets. Do something about it." And then he walks out of the room. This was not a president who sweat the details. He knew that there were some things that just had to be done. We had to get tax rates down. We had to slay inflation. We had to win the Cold War. And lo and behold, after 8 years, all of those things happened. And the point of all this is once we got the policies right, look at what happens. This period, from 1981 through 2007, is the greatest period of prosperity in the history of the world. No country has ever seen anything like what we have been through in the last 25 years. Put this in perspective, this upswing in the market. And by the way, it's not just, you know, it happens under Reagan and then Bush and Clinton, and I have to think on economics, Clinton was a pretty good president, and even through George Bush in his first 7 years until the market collapses. Over that period, we created more net wealth over this period from 1982 to 2007 than in the previous 200 years of our nation. That's a pretty amazing thing to think about. In 1981, the net worth of the United States, that is all assets of all American businesses and households, minus their liabilities, was $16 trillion, 1.6 trillion. By the end of 1987, the net worth of the United States was $56 trillion. We added $40 trillion of wealth. And why did that happen? It didn't happen by accident. It happened because the policies worked. And let me talk about some of those policies. Now, this is one of my favorite charts. I mean, goddamn, I wish that Barack Obama were sitting right here so I could explain this to him. I mean, this stuff is so important. This guy just doesn't have his tray table in the upright and locked position when it comes to this stuff. But let me kind of walk you through this. Now, this dark green line here, okay? The dark green line is the tax rate. Who here in this room can tell me what the highest income tax rate in the United States was in 1980? I heard somebody in the back say 70%. 70%. And by the way, what a 70% tax rate means is that for every additional dollar that you earn, either as an investor or as a worker, right? For every additional dollar, if you're basing that 70% tax rate, it means the government keeps 70 cents out of the dollar, right? And you keep 30 cents out of the dollar. That means that if you're an investor, you have to have a high rate of return on that investment to compensate for those high tax rates. And so you can see Reagan comes in and says, look, we got to cut those rates. We cut the top tax rate from 70 to 50, and then he cuts it from 50 to 28% a few years later. That's a big, big improvement. What that means, I mean, think about this in the, again, those of you who are investors in this room, think about what that means, to cut the top tax rate from 70% to 28%. It means, you know, rather than not keeping 30 cents on the dollar, right, at a 70% rate, now you get to keep 72 cents on the dollar. So what Reagan has essentially done is he has doubled the after-tax rate of return on investment, right? Does that, you follow that, you know, logic? And it's not too surprising, you get a boom when you do that. When you cut tax rates, the value of investments goes up. And you can see the tax rate went up a little bit under George Bush, it went up a little bit under Clinton, it came down a little bit under George W. Bush. But the point is, the main point of this is that we start the period with a 70% rate, and at the end of the period, we're at 35%, okay? So we've cut the tax rate in half. Now, look at the light green line, and this is the part that Barack Obama, Larry Summers, and Tim Geithner and all these don't get. If you look at the beginning of the period, when we had a 70% tax rate, the richest 1%, you know, those evil 1%, the people like Warren Buffett, and Tiger Woods, and Hannah Montana, people like that, you know, the richest 1%. That richest 1% paid 19% of all income taxes in 1980. Today, 41%. That, to me, is an amazing statistic. The only possible explanation for that is a Laffer curve effect. That when the tax rates were cut, you've got more wealth created, you've got people paying more tax at the top, and you can see this in spades. I mean, what other explanation is there that tax rates matter? Now, oops. This is another way of looking at it. We hear a lot about tax fairness, right? I mean, this is something that spouts out of the Democrats every single day, tax fairness. We have to raise tax on the rich because it's the fair thing to do. Well, here's the amazing thing. If you look at this chart, top 1%, now it is true that top 1% make 21% of the income, so it's true that they do make a big share of the income, although one thing that's interesting about the U.S. economy is the people in this top 1% category, this category changes, people in that category change year after year after year. People 1 year in the top 1% aren't likely to be in that category 3 or 5 years later, and the statistics show that very clearly. But they pay, you can see, 39 to 40% of the tax. But here's the amazing thing down here. The bottom 50%, all Americans with an income below the median income in America today, all of those Americans, they pay 3% of the income tax, 3%. So one way of thinking about this is, this room is equally divided right down the middle. So all of you on this side of the room, you're in the richest 50%, and all of you on this side of the room, you're in the bottom 50% in this, of the people in this room, okay? And we're going to decide how we're going to pay for this wonderful conference that you all put on. And so if we pay for this conference the way we pay our income taxes, you all on this side of the room, you get to pay 97% of the tab, and you all on this side get to pay 3% of the tab.